So I often help clients purchase businesses, not creating them from scratch, but acquiring an existing business, whether that be a franchise or just a business that they've had their eye on in the market, and they see the opportunities. Maybe somebody's retiring, or they're just trying to get out of the industry altogether. So there's often a question of how should that purchase be structured. And there's usually two options. There's the asset purchase agreement and there's the stock purchase agreement. So in stock, while that relates only to corporations, I use that as kind of a general definition of an interest in a company that's being purchased. So that could mean an LLC membership interest or corporate shares or stock. So I'm going to refer to it as stock, but it's going to refer to the purchasing of the ownership interest in a company rather than its assets. So the difference is pretty substantial as to potential ramifications in the long term for the business. So when a buyer does an asset purchase agreement, they're usually either using their existing business entity, so either it's an LLC or corporation that already exists, maybe it's a business that's expanding their market or acquiring a competitor, or they're creating a new LLC or corporation to buy the assets. So what's actually being purchased is all that the selling business owns. So it's going to be their equipment, their inventory, their accounts, intellectual property. It's going to be goodwill. It's going to be maybe contracts or contract rights and stuff like that. So it's the things that make the business valuable, but not the actual entity itself. So you're not actually buying the corporation or the LLC. You may also be buying websites or phone numbers, those sorts of things. That will all fall under the asset purchase agreement. What's not included, however, are liabilities. So that's the big distinction, or the number one, at least, distinction. There are several between a asset purchase agreement and a stock purchase, is that the buyer can really shape the transaction however they want. They can include or exclude whatever assets they'd like. So, for instance, if you don't want to buy, the office furniture of a business, you just want to buy, the accounts, the receivables, the vendor accounts, those sorts of things, then you can specifically exclude, office equipment or vehicles, those sorts of things, if you don't need them. You can also include or exclude any liabilities you want, or exclude all liabilities if you'd like. And that's the main benefit of an asset purchase, is you don't have to assume known or unknown liabilities. So if you were to purchase stock, you're taking everything that comes with it, known and unknown liabilities. So there could be a tax lien sitting out there. Hopefully, if you did good due diligence, you're going to find a tax lien, but you could have creditor claims, previous employees making claims of harassment or discrimination. You could have Wage and Hour Act issues. You could have workers' comp issues. Things that go along with running, the day-to-day of a business can come back to bite the buyer, up to maybe 3 to 4 years later, depending on what the statute of limitations is for the specific cause of action. So it's not necessarily just debt, but it absolutely could be debt. So when you take the stock of a company, you can't exclude liabilities. You can't, pick and choose those sorts of things. You also can't exclude assets. So if there's an asset class that you're just not interested in, if you're buying the stock of a company, you're going to buy that asset. So the way that we normally will structure an asset purchase agreement is to set up a bill of sale with an exhibit that lists all the assets and pretty much a categorical exclusion of liabilities, which will essentially exempt all the liabilities from the purchase except those that are specifically assumed. So you may have a piece of equipment that's being purchased that still has a note attached to it, maybe or maybe a lease attached to it if it's like heavy equipment or trucks, those sorts of things, that you're fine assuming the liability with the asset because the asset's important to the business itself. For instance, if you had printing machines, most large-scale printing companies lease their equipment. So in order to purchase that sort of thing, that sort of business, you're going to have to assume the leases of that printing equipment unless you are going to set up your own new lease arrangements, which is it's not super common for that to happen. Likewise, the lease for the location, if it's a rented location, that lease is going to have to be assumed and assigned to the buyer. So those aspects of the asset purchase can make an asset purchase much more palatable to a buyer than a stock purchase. Now, a stock purchase is generally going to be a lot easier logistically to effectuate because all you're doing is buying stock. So the seller is going to convey either shares or membership interest to the buyer, and the buyer really doesn't have to do anything else. They're going to change the tax information and those sorts of things, but that's it. They don't have to retitle the assets. It's just plug and play. So what's really changing is the owner of the company, not the company itself. But again, with a stock purchase, you take everything that comes with it. So the scary part of that is you just don't know what's out there. And unless the seller is incredibly solvent and willing to execute a very robust indemnification agreement, you may be stuck with those liabilities should they come up. And a lot of times sellers aren't going to want to indemnify anything and everything. They may specifically carve out potential types of liabilities, or do what's called a bucket and have a certain sum of money waiting out there that could pay liabilities up to a certain amount within a certain time period. But that may not be sufficient to make you whole. So the asset purchase is generally going to be the way we go about buying a business, and that's usually the primary strategy used by business lawyers. So when you're looking at buying a business, whether it's going to be a franchise or an independently owned business, whether your business exists already and you're buying a competitor or not, doesn't really matter. The asset purchase is probably going to be the way to go.